Hi, I'm Faizan. I'm from Pakistan, and I'm going to pitch Ascena Retail Group. It goes by the ticker ASNA on the New York Stock Exchange, and I think it's a buy. So let's see what the company is. Alright, so basically what Ascena is that it's a specialty retail company. It owns and operates a whole host of brands that are focused on women and girls. So in total, they've got like 4,690 stores in the U.S. and they got a few outlets outside the U.S. too, but like it's primarily focused in the U.S. All right, so it's brands spread across their premium fashion, value fashion, plus fashion, and their kids fashion segments. So let's know a little bit about the brands. All right, so the premium fashion segment is about 34% of all sales. And it includes two brands, and I'm sure you've heard of these, Ann Taylor and Loft. I mean, like both of these brands are very popular. I'm not an American, but when I came here and I asked girls about it, and they were like, we wear it every day, and it's like very popular amongst them. All right, so they've got like this segment has 988 stores, outlets, and some e-commerce operations. All right. So the value fashion segment is about 30% of all sales. So they include Maurice's and Dress Barn, and I'm sure you've heard of these too. All right, and both brands offer like moderate to better quality apparel at reasonable prices. And they've got about 1,734 stores and some e-commerce operations and some international franchises. All right, so the plus fashion segment is about 21% of top line. It includes Catherine's and Lane Bryant. It's got about 1,100 specialty stores and some e-commerce operations, just like the others. And it's the go-to place for plus size wearing women. So it's like the go-to place. Like the women who wear plus size, they don't go anywhere else. All right. So that's a huge barrier of entry for other players. Alright, so the kids fashion segment is about 15% of all sales, and it's focused exclusively on girls aged 6 to 12. And it's, again, a highly recognizable brand among the demographic. Alright, it consists of the brand Justice, and it's got about 900 stores and outlets and e-commerce operations. Alright, so this shows that the company has like a balanced revenue contribution. And Ascena definitely believes that it should not have all its eggs in one basket, and it's pretty good. All right, so when you pull up the stock chart, all you can see is a sad story. It's like retail has been whacked for the past few years, right? And the stock is down 90% from its 2014 highs of $22 a share. And here's a summary of what caused the adversity. All right, so the first thing is that the stock was way overvalued in 2014. At like 40 times earnings for a brick and mortar company, that was like crazy. And it had to go down. So the retail headwinds meant that sales went down a bit, and investors were scared about Amazon and all that buzzwordy things, so they just kept selling the stock. Alright, so Ascena tried to solve that problem initially by trying to buy themselves out. So they bought Ann Taylor and Loft in a $1.8 billion deal where they, most of it, in a $2.1 billion deal where most of it was funded by a 7-year term loan. And this was a variable interest term loan. Okay, so another reason why the stock hammered was because in 2015, even though they bought Ascena, but they still disappointed, even though they bought Ann Taylor, they still disappointed expectations. So the market was pretty negative on them. And the last nail in the coffin was basically in 2017, the company wrote off a huge impairment in intangible assets, right? So that was taken as like Amelia Bedelia literal, and everyone was like, you know, we should sell the stock because the companies had like $1 billion in impairments. I'll tell later why it's like a misunderstanding. Okay. All right, so why is it mispriced? Okay. Here we have a company that makes $6 billion in revenue, all right, as of the most recent year. And yet it's valued at $300 million. That's like 2% of sales. We've got companies that are valued at 10 times sales, 15 times sales. All right, so we've got to see that this is a company with $100 million in cash flow, And it's like the third biggest specialty retailer in the US by revenue. And it also holds a lot of cash, about $413 million. All right, so I think the problem with the investors, Ascena investors, is that they're not looking at the big picture due to like a lot of short-sightedness. And I think there's a real opportunity to buy the stock here. And I think the real value of Ascena will be reflected in its stock price due to mainly their change for growth plan that has been implemented in late 2017. And also due to other positive signs. So like they got a new operating model, they're closing unprofitable stores and they're streamlining efficiencies. They got growth in their digital channel. The management's interests are aligned. There's an enormous share buyback plan. And there's a very poor bear case on the stock. So let's go into some details about these. So the write-offs. Okay, so in Q3 2017, Ascena wrote off $1.34 billion of impairments in intangible assets. So it's not like someone charged them with cash, right? It's just paper loss. So they wrote down their intangible value. So the market took it very negatively, and the stock went down 56% on that same day, and it's been hovering around that level. So why I think it's a misunderstanding is because when you go back, when most of these write-offs came from Ann Taylor, right? So when Ascena bought Ann Taylor, you could see in their 10K, page 73 of Ascena's 10K, Ann Taylor basically wrote up their intangible values very aggressively before the deal, right? So the seller got the better deal, right? So they had, I think, the act of basically writing off impairments was a disciplined action by Ascena that was to put a fair value on their intangible assets. All right, so new operating model. So before there had to be like presidents for all brands under David Jaff, right? And this was a very inefficient structure because no one would, and no one was actually responsible for the internet and the e-commerce, which was like this big paradigm shift coming. And the new management structure, I think, is very helpful for the company because you've got just David Jaff, and under him, the CEO, and under him there are two people. One's responsible for all brands, and the other is responsible for the services, which is basically another name for the internet and the e-commerce thing. So this ensures a centralized control of all brands, and it also shows that the company is not trying to fight the internet. So it is basically focusing on the e-commerce and trying to fight the giants. All right, so the company's closing stores that are unprofitable, and investors wouldn't take this as a good sign, but I take this as a good sign because if you look at a recent company, Kohl's, KOHLS, and that stock is up like 90%, and it had the same problem. There was like irrational selling, right? So what basically Kohl's did was that it started closing unprofitable stores, and through this, like their sales didn't go bad too, and their operations became better. So I think it's the same with Ascena. So they closed their unprofitable stores, and the rest of because they got a lot of stores in one location, right? So if they close most of them and keep some of them in one location, I think the sales won't get hurt, and I think they'll make a profit. All right, there's also a cost synergies program that is expected to lead about $250 to $300 million in annual cost savings. So there's very good growth in online transactions, right? As you can see in the graph, it shows that the company has been somewhat successful in attracting online traffic. So the management is definitely incentivized by a turnaround because they hold options that have an exercise price of $11.42. The stock is trading at $2 right now, so definitely the management would be really willing to turn around the company. All right, and the CFO talked in the latest earnings call that they're repatriating about $200 million in the current quarter, right? Because of the tax cuts and everything, they're bringing money back. So they're definitely going to pay it either they're going to use it to buy equity, or they're going to pay off the debt. So it's a win-win structure. And if they buy like $150 million or $200 million of the stock, that'll bid the stock to highs. All right, so the bear case on the stock is very poor. I tried to find like a good bear case on the stock where there was like a very good argument by an analyst that this company is the stock is going to go down, but I couldn't find one. It was like they were like what do you say? Like they didn't have a good argument. All right, so investment risks. A downturn in the economy could definitely hurt sales, especially in the premium segment. And there's always the interest rate risk. As I told you before, the variable term loan, for every 12.5 basis point increase in interest rates, the company has to book $1.2 million of more interest expenses. And there could always be an acquisition, which is like a risk to my investment thesis.
Okay, we'll call it that.
All right, so a quick summary, a strong brand new operating model. You see that. All right, so the valuation, I think the company will grow at 2% per year, which is quite manageable, and at 2023 it'll earn about $7.2 billion, and it'll have a net income margin that will be similar to their peers, and at around $1.67 a share, and a PE ratio of, I think the market will bid it at a PE ratio of 10, which is like quite conservative, considering that the average competitor trades at 15 times earnings. And at that PE, I think the value of Ascena at 2023 will be $3.2 billion, which is like good upside from where it is today. And so I think it's trading for pennies on the dollar, and I think it's a buy. Yeah.
First place. First place in our view, there's a lot of discussion around this, was the stock Ascena presented by Faizan Mohammed from Pakistan. I think that just a few comments. Faizan, I think it was impressive that you chose a controversial stock, a stock that was well out of favor. In our eyes, it was a true stock pitch. You sort of were presenting it. You were addressing the controversial aspects of the stock, why it was out of favor, why you felt that was going to turn around. It wasn't an easy stock to defend. You did it on your own, and I think it was. We were all very well impressed at your efforts at explaining why this might be a turnaround story. We were impressed, and it was a good job.